What is angel investment and what is venture capital investment? Well, to begin with, who are these people? Okay, angel investors are high net worth individuals who want to allocate a certain percentage of their investment portfolio, their savings, into higher risk ventures that have the potential for high reward. And I note that this is a small percentage of their overall portfolio. Some have a higher percentage than others, particularly formerly successful entrepreneurs tend to invest a lot of their money back in entrepreneurial ventures. But these high net worth individuals, either individually or more commonly now, they get together in angel groups and they invest money into startup ventures. That is, they purchase an ownership interest in the startup ventures. Venture capital groups are a little different. These are professional money managers. This is their only goal and objective is to manage the money of others, and they go out and they raise money in the form of funds, and then they put these funds together and they specifically invest in startup ventures. Usually for a particular fund, they may have about 10 startup ventures that they invest in. They do it in periods so that the money that they call down from investors, that is the people who subscribe to the investment fund, they reach out and they get the money from them to put it in a venture, and they fund the venture at milestones. So they don't put all the money in up front. They put some in at maybe beginning, year 1, year 2, year 3, that type of thing, and they continually fund the business throughout. And so they organize the investment process, they identify investment targets, and they make investments collectively as an entity, and the investors, known as limited partners, right? Because the venture capital firms organize as a limited partnership, they invest here. The money managers, the VCs, they get a management fee and they make a percentage of whatever they ultimately sell the interests that they've invested in for. So if they invest in 10 ventures and some of these ventures sell to others or receive capitalization from others or go public or something like that, and the venture capital firm sells its interest in that business for a profit, all that collectively, that profit, the VCs take a percentage and the limited partners take a percentage as investors. And that's the way that model works, right? So what do these individuals look for when they're investing in firms? Well, they don't want a small business, right? A slow growth business. They need something that's going to grow rapidly over time. And generally this means some sort of business with a repeatable business model that's scalable. Okay, repeatable means you create the value proposition one time, and that same value proposition you've created can be sold multiple times, like a software or something like that. And it's scalable. It can reach people at large. It can grow rapidly. Okay, it can achieve massive scale within a short period of time. And when we say short period of time, usually it's somewhere 3 to 7 years is what they're looking at for that rapid growth period. Okay, so these are the types of firms that they're investing in. This is normally going to be software or something like that, software as a service, or something other that has unique scalable potential, maybe something with unique intellectual property associated with it that you could license out or that you could keep others out of the market so it could grow very quickly. All right. So what does an investment deal like this look like? Well, generally what you're going to do is as an angel investor or a venture capital firm, you are going to negotiate directly with the startup, the entrepreneurial venture, the founders, at the terms at which you will put money into the business and the interest that you will receive. Most investors want a form of preferred stock. That is, the entrepreneurial venture should be organized as a corporation, usually in Delaware, and in exchange for the money invested, the investor will receive a convertible participating preferred stock, okay, a PCP stock. And what that means is the investors hold a preferred status. They have all these special rights that are in excess of those of a common stockholder, that is generally the founders of the company. They're going to have expedited rights to payments. They're going to have a multiple of the money they are invested returned to them before anybody else gets paid. They're going to have special information rights and voting rights, that type of thing. Okay, maybe dedicated seats on the board of directors. Yeah. So these are the types of terms that they're looking for, and this all begins with the investor pitch from the startup venture, then a follow-on digging into the details, right? A follow-on meeting after the pitch to dig further into the business plan and the details and things like that. And then comes the investment. You work with legal professionals to help you structure the offering, because a startup selling an interest, they're selling a security, okay, for the definition of a security in this case being an ownership interest, or even something like a convertible note is considered a security. So that's regulated by the law. So these legal professionals will memorialize the transaction, help you negotiate the terms of the deal, the term sheet, and then they'll make certain that you comply with the securities regulations associated with this sale of a securities interest. And so once all of this is worked out and you verify that everything that the startup venture tells you is true, that is, you go through what's called due diligence. Once due diligence is done and you verified things like, ownership status of things, governance structure, potential legal liabilities, accounting and tax issues, things of this nature, and you're confident with everything, the investors will, again, go ahead and put money into the venture at a predetermined rate, right? It usually set out in milestones. The money's called down. So you're going to invest $1 million. It may be $250,000 up front, with $250,000 coming at the end of the year, and then next year $500,000, that type of thing. So it matches the growth path or the need of the startup venture. So that's what these deals look like. In summary, this is how this works. The technical aspects can get very detailed, and you can dig into each of those technical aspects further. But starting from here, this is the starting point for what it means to get angel and venture capital investment.